This is Leonard Sanicola for WorldatWork TV. Today's topic is the value of pre-tax benefits for both employers and employees. U.S. tax laws allow employers to deduct certain items from gross wages, so those items are not counted towards taxable income. For example, pre-tax benefits typically will include a variety of health care benefits, such as medical and dental premium contributions, certain welfare and commuter benefits, and contributions to 401k or 403b plans. Since a pre-tax deduction represents, in effect, a reduction in salary or wages, pre-tax benefits represents a reduction in taxable income for the employer. An employer would typically pay less in Social Security and Medicare taxes, less in federal taxes, and in most cases less in state and local taxes, as well as other payroll taxes. In addition, offering employees access to pre-tax benefits helps with one's total rewards programs and the attraction and retention of employees. What are the advantages of pre-tax benefits to the employee? Participating employees who elect to have pre-tax benefits will have a reduced tax liability. For example, employees that pay for their health premiums through payroll on a pre-tax basis will pay less in Social Security and Medicare taxes, less in federal taxes, and in most cases less in state taxes. On the retirement side of the house, employees that may contribute to an employer-sponsored retirement plan, such as a 401k or 403b, will typically pay less in federal and state income taxes by paying their contributions on a pre-tax basis. Now, later, when there is a distribution of a retirement account, typically that will invoke a taxable event, but the hope is that the individual will be in a lower tax bracket at that time and has paid less in taxes over the lifetime of their participation. Let's now discuss FSAs, HRAs, and HSAs. Those are acronyms for a variety of account-based plans that offer pre-tax benefits. Let's begin with the Flexible Spending Account, or the FSA, because that's been around the longest. Both the medical and the dependent care FSAs are funded primarily by employees through pre-tax contributions. Let's talk about the medical FSA first. With the healthcare and medical FSA, employees may make an annual election to set aside dollars to pay for qualified, unreimbursed medical expenses. These pre-tax dollars fund the account throughout the year via an individual's payroll check. Under the Affordable Care Act, an individual may set aside up to $2,500 annually. There is also a Dependent Care Flexible Spending Account, or FSA. Similar to the Healthcare FSA, employees may make an annual election. However, these dollars are set aside to pay for qualified, unreimbursed child care and elder care expenses. The maximum allowable amount that may be set aside under federal law is $5,000 per household. For both of these types of accounts, amounts allocated are free from federal income taxes, Social Security/Medicare or FICA taxes, and most state and local taxes. Both accounts are subject to forfeiture rules. There are many rules governing these plans that one should become familiar with. Another type of account is a health reimbursement account, sometimes referred to as a health reimbursement arrangement, or HRA. With this account, the employer establishes a tax-free reimbursement account entirely funded by them. Through HRAs, employers reimburse employees directly for qualified out-of-pocket health care expenses. Benefits remaining in the account at year-end are rolled over and may be used to cover future medical expenses as long as the employee remains with the employer. The final type of account-based plan that I'd like to discuss is the Health Savings Account, or HSA. With this account, an employer purchases a high-deductible medical plan and establishes a tax-advantaged trust or custodial account created for the benefit of employees. Employees and employers both may contribute to the account. Amounts in HSAs are portable when an employee leaves his or her employer. HSAs offer a triple tax advantage. Contributions going in are pre-tax, investment earnings grow tax-free, and qualified distributions are tax-free. In order to participate in a health savings account, it is important to remember that a participant must be covered under a high-deductible health plan rather than a traditional health plan. I like to call the HSA the medical IRA or the medical 401k because it is a healthcare nest egg. HSAs are very popular today, and there are many rules that govern not only HSAs, but FSAs and HRAs. In fact, there are many rules that govern the interplay of flexible spending accounts with HRAs and HSAs, and it is important to become familiar with those rules. There are many provisions that govern these account-based plans for both employers and employees. There is more detailed information on the WorldatWork website. For the most part, taking advantage of pre-tax benefits is a win-win opportunity for both employers and employees. For WorldatWork TV, this is Leonard Sanicola.